Every trader asks the same question. What stock am I trading today? Right? When you open your screen in the morning, that is probably the first question you ask yourself. And the reality is a lot of people who don't do the right homework, they're not well prepared. They typically just are chasing trending stocks. And by the time you find these stocks, it's already too late. You're pretty much chasing them. There's no real plan or any trade management or rules in place to help you get the most out of that trade. So in today's video, I'm gonna show you guys my full breakdown of what my game plan is for the weekend and what I look at going into the pre-market open. Any of the trades that I take throughout the week, day trades, scalps, whatever it may be, all of those trades are pre-planned based on my weekend prep. I'm not going over these setups every single day in the morning and having a plan then, because we don't really have that much time at that moment. Over the weekend, market is closed. You have much more time for preparation. You can go over your watch list and filter through to which stocks look good versus which stocks are not something that you're going to be watching. And that's where the real process begins with. So first, I'm going to explain to you guys all the criteria, and then we'll look at a chart on a trade that we took in the past, and I'll show you guys that same criteria being applied in a real life example. Now, when you're looking at the charts over the weekend, the first thing you want to look for is some sort of a pattern. There has to be a pattern that shows you that the stock has the potential to go in up or downside direction. Obviously, we're looking at one of the two directions when we're taking trades. So that has to be the main thing that you're looking for, right? It could be a cup and handle, it could be a head and shoulder, it could be your trend lines, right? It could be support and resistance break, it could be supply and demand breaks. There are a lot of patterns and setups that you can look for on the longer time frame, right? I obviously don't look for all of these patterns that I just named. That was just an example. A couple of things that I look for is either consolidation for too long, and then I have those levels where I look for those breakouts and momentum coming in after those breakouts happen, or it could be some sort of pattern such as a bull flag, bear flag on a longer time frame. I don't really like to complicate my trading, so I don't have a bunch of patterns that I look for. But these are some of the main things that I look for when going into the weekend for my preparation for the week. Now, once I find a pattern, right, what I look for on the daily chart are something called gaps. So what gaps are, this is where on the daily chart, you're not going to see any price activity at all. This is usually because if we have a very aggressive move overnight that causes the stock price, let's say closes at $5, the next day it's opening up at $9, right? Obviously, when you look at the pre-market, you're going to see there is price activity from going from $5 all the way to $9. But when you switch to a daily chart, you're not going to see any activity because the daily chart is only showing us where the price closed yesterday and where it's opening up the following day, which is 5 to 9. Now that difference is $4, which is going to be your gap. Now that really isn't a pattern that I'm looking for, but when price is going towards that gap, for example, let's say the stock moves up from $9 to $11 and a few days pass by and it's showing weakness and it's starting to come back down. Now I'm going to be paying attention to, all right, what patterns are forming that can give me the confidence and confirmation that, all right, the stock is going to move downside. And the second thing is the gap. Where does the gap come into play? This is where your trade management is going to come in, right? If you're looking for an entry into the gap, stock is showing weakness. Now that is telling me that if it breaks into the $9, it has a gap where it is going to come down. There's other traders looking at those gap plays as well. That's going to drive the price lower, obviously with confirmation, right? You don't want to take any type of setups without your confirmations, but assuming that the confirmations are there, that prepares me for that setup, right? First, a pattern, which could be slowdown of price action, lack of volume, bull or bear flag, into a gap, or it could be the supply and demand zone. These things help you manage your trade so you can have the confidence to hold the trades for a longer period of time. I'm going to show you guys an example of a hinge trade that we took a couple of weeks ago. But before we get into it, I want to explain the full criteria of exactly what we look at to get to that point. Because obviously when you're waking up and you're jumping into these momentum trades or trending setups, you're most probably just chasing without a plan. And if in the back of your head, if you don't have the conviction that the stock has the potential to move this much, and that conviction is going to come in, for me, it's from the gap, you're not going to be able to hold those trades for a long period of time. So once you find that trend, the pattern, and in my case, the gap, right now you have your confirmation that, hey, if the stock does X, Y, and Z, it has a high probability of going into the gap. So once we have that, we move on to the pre-market. So let's say now today's Monday morning or Tuesday morning, and that setup is now starting to show some potential. So here's how you find more confirmation or conviction into your trade idea, right? So let's say we're looking at that short trade that I mentioned that went from 5 to 9, right? Continued to 11, and now it's starting to pull back towards that gap, right? At that point, now look at what the overall market is doing. So what I watch is SPY. So let's assume that now Monday morning happens, SPY gaps down, right? Pushes very aggressively, and it's showing a lot of strength towards the downside. Now I look across my watch list and I see which stocks from my watch list that I created over the weekend are showing relative strength with the market. So let's say that particular stock is stronger. It went from $10.50 to $9.50, right? Making a more major move than other setups that I'm watching. And it's outside of an inside day, outside of the range from the previous day. Now that's telling me that this stock is showing more strength into that particular direction, even though SPY is already moving there as well, but it's more aggressive, right? So that means that there is more relative strength in that direction. Now that's going to be one of my main watch for that particular day. Now, as the time progresses into the open, you can differentiate that type of a setup between, are you going to take it as an opening drive or are you going to wait for the opening range to set up, right? Which could be the opening range setup or break and retest of that range before you jump in. Now, relative strength is one of the main driving factors for the stock selection, right? Obviously, you want to make sure that you're doing your weekend prep, but when you see the relative strength coming in pre-market, this is one of the main drivers of, all right, am I taking the opening drive or the opening range? But if you don't have relative strength, like for example, let's say the stock is now within previous day's range while almost everything else is pushing on the downside for the example that we're using, that means that that stock isn't showing that much strength towards the downside. So for me to now go after a stock that is in between previous days high and low, while almost 90% of my watch list is well below previous day's low on that particular stock, that means that that stock doesn't have that much strength. And I would be wasting my time going after that setup. Now, that's not to say that it doesn't have the potential to move on the downside if the market drives lower, but the probability is a big factor when determining if you should be going after that, right? Trading itself is all about probability. The more conviction and probability you have in your favor, the higher the chance of that trade working out, right? Nobody knows where the stock is going to go. That's why when we look into probabilities, we look for confirmations, and that's where those high returning trades come in from. Now, let's go over this on a chart on a trade that we took a couple of weeks ago. The chart we're going to be paying attention to here is HIMS. So when you guys look at the HIMS chart here, right, we have a range that this has not been able to kind of break out of, which is roughly around the 53.50 range and down to the 40 range, right? You see we're hovering in between that. So now we found mini support and resistance within a range that the stock has been kind of moving into for quite some time. And when you zoom out, we see that it went from 30 all the way to 65, right? Then pulled back. And then because of some sort of news, we have this big gap forming right around between this $48.33 all the way to 63. Now, some of this gap has already been filled. You guys can see we went all the way to 53 and change. That means majority of the gap has been filled. So what I'm gonna do here, right, is now I'm going to identify what the leftover gap is, right? So the leftover gap is right around 53 and change all the way to 63. So on the weekend, I don't know when this setup is going to give me the opportunity. Is it going to be Monday? Is it going to be Tuesday, Wednesday, Thursday, Friday? I don't know. I do know that once we get some sort of confirmation, once I see the stock is pushing in above the previous range and it is going into the gap, that is going to give me the confirmation to take the trade and then hold it for a longer period of time. Now, when can I hold the trade for a long period of time or get a confirmation that this is a good trade that I can let the runners keep going in my favor? That's going to be determined by this area here, okay? If you take a trade anywhere between $50 and change to 53 and 50, here I'm not going to be that confident in holding my runners. Why? Because we've already failed between this range in the past. So for it to have a high probability and for it to give me the confidence to hold this trade for a longer period of time, I want to see it breaking into this gray area, right? So now, again, that doesn't mean that we can't take an opening drive or an opening range, because when we go into Monday, Tuesday, Wednesday, whatever day the setup is presenting itself, the opportunity for a trade is always there. But the opportunity to hold hold the trade for a long period of time with high probability, that's something you're not going to see that often. So when you see something like this, there's a couple of things that can help you decide what your position size is going to be, right? So if you guys haven't watched the video I made on proper position size management, I would highly recommend you guys go watch that, because when I see a setup like this where there is a gap, there are high conviction setups, I tend to take a larger position size, and that larger position size is not the reason why you'll see big returns. Majority of the big returns are going to come in from what usually happens within this area, right? This area is where I'm certain, all right, we're in a gap. We had a high probability setup from the weekend. It's going into that gap. And now once the stock pushes into the gap, now I'm much more relaxed. I'm much more confident in that trade. And even if I take 50 or 70% of my position out, now the remaining 30%, if you guys go watch some of the previous trade recaps I've done, all of the big profits that are coming in from those trade recaps, you'll see that 90% are from the runners, not from the beginning of the trade formation. It's usually the trade management into a gap or a continuation of that momentum that gives us that high return. It's usually never the first scale out. It's usually after the 50 and 70% scale out of my position where you see those big returns coming in. Now, once we go into the pre-market data, right, I'm gonna pause it here, and now you can see where is the price from pre-market. Right now, previously we rejected around that $50.50. Okay, so this is the zone, and we know that we have a gap over $53. So at this point, if we are watching this as an opening drive, right, which is going to be the pre-market high level of us around $50, and the strike that I would normally go for is either the 51 or 52, not going too far out. So let's say we take the 51 strike. Our entry is once we break the pre-market high, which is around $50.30. We have to keep an eye on the previous day's high as well. This is where we failed around $50.60 and change, right? This is us determining the opening drive, right? If you miss the opening drive, then it could be the opening range, right? Once we fast forward, assuming that you took the opening drive, right? I'm gonna just go slightly above to 15 minutes, 14 minutes actually, right before the opening range break is setting up, right around here, right? So at this point, we have that 15-minute range set up as well. So if you miss the opening drive, this is going to be your second chance, right? When we look at the 5-minute time frame, what we usually look for is a pullback. So now the range is 51.80. So we're looking for, this is going to be our opening range breakout, right? So the previous entry, which I was explaining here, was our opening drive, right? So if you're in that different category, you're going to focus on holding the trade. If you're in the opening range breakout category, you have to wait for the 15-minute. If not the 15-minute, then you have to wait for the 30-minute. So if you're somebody who needs to wait for the 30 minutes, right? Now we're going to fast forward to almost 10, which is going to give us now our 30-minute range. When you look at those three different trading strategies, right? You have your opening drive. Now, the person who gets into the opening drive while doing their homework, they have a much better entry in this trade. They can hold that trade as long as the strike is in the money. That's one rule you guys want to have for opening drives. If your strike becomes in the money, so you guys see here, we break out of 51, and that was the strike that I mentioned earlier for opening drive, right? At this point, we retest that 51 and we continue. So after this candle, the second green candle for the opening drive, you're at a much comfortable position because in the money contracts, you don't lose much value. You don't have to worry about closing your trade out. You scale out 30 to 50%, and then remaining runners, you get very comfortable with scaling out slowly, right? At this point in the trade, for the opening drive and the 15-minute opening range break setup, for those two traders who've taken that trade, your main focus is going to be if this has a follow through in volume into this range, it has a very high chance of giving you a very good return. Well, not a very good return, it's going to give you an explosive return, because if you're in within the first 15 minutes, you're in the 15-minute range breakout, or you're into the first 5-minute of opening drive breakout, you are at a very comfortable position. All you have to worry about here is trade management, right? That's where the second part comes in, what I was explaining earlier on in the video, that once you find a pattern, you need some sort of conviction, some sort of confidence booster to hold the trade longer. So for us, that confidence booster is going to be in this gray area, which is our gap. You can put whatever color you're comfortable with, remembering that, all right, this is my gap. For me, the gray area is something that helps you kind of remember that, all right, this is my gaps, and I usually delete them once the gap is filled. So let's fast forward a little bit more. And I want you guys to pay attention to how price and volume are pretty much respecting going into the gap, right? So you guys see how as we push higher and higher, right? At this point, when we were first looking at our trade, we had we had drop of volume right here, but then followed by that, we had very aggressive volume right when we break into the gap. So now you're probably wondering, why was there a big aggressive spike in volume, right? Most traders are getting notified of HIMs or of this setup right around one of these three candles. People are trading something else. They don't have this on their watch. Somebody tells them about it. So we see the spike in volume here because there's a spike of interest, meaning a lot of traders start getting this on their watch. Somebody tells them about it. They put it on their watch and they're like, oh my God, there's a gap there. Or this has been showing a lot of strength. So when they start jumping in here, traders who have gotten in on the opening drive or the opening range have a big advantage over these other traders, because what happens here with the option premiums is you have an imbalance or a spike in those option premiums. So think of it like this, right? So here, let's say I'm looking to scale out 10 out of my 10 contracts, maybe 2 or 3 contracts, and I'm very comfortable with price I get. So when I look to exit, let's say the contract price is at $2.50, and you have everybody else who's rushing into those trades, right? You have my order that I put for $2.50 getting filled at $2.60 or $2.70. Right? Why? Because there's other people who are impatient and they're okay overpaying for those. So you start to get that slight imbalance usually around here when there's a spike in volume, because there's a spike of interest. So at this point, for opening drives, opening range traders, you are at a very, very comfortable position. You can start to slowly increase your stop loss and let the trade keep going, because now it's in that gray zone where we have our gap. Move the time up a little bit. And as you guys can see here, right? We go into the gap and we have a little bit of a pullback into the 53 level, right? And we still holding, as long as, again, the traders who got in at the opening drive or opening range should be completely fine, because this pullback is not going to affect their position that aggressively in terms of, premium loss of value. Now, when we go forward another 10-15 minutes, we start to move back into the gap, but now you guys will see it's the excitement is not really there, right? Majority of the excitement entered here when there was a gap, and this is where a lot of people ended up getting caught because they got in too late. They got in when people who were already in are taking their profits, right? They got faked out. People started closing the trade. That caused a little bit of turbulence. We pulled back and now we're starting to go right back. And at this point, if your stop loss is 53, you can now increase it to this level, which is 53.50, right? So fast forwarding this a little bit more. So I think this trade, the premiums went roughly 300 to 400%. And shaking those people out, we see that continuation again. Right? And now at this point, going back to the opening drive and opening range traders, you're at a very, very comfortable place. Even if you go in with 5 contracts here, and by the time it's at this point, even if you're holding 1 contract, right? The power of holding 1 runner that keeps going in your direction, in your favor, can accumulate crazy returns, right? And it's all about trade management. It has nothing to do about how many entries you can do, right? How many times can you scale into a trade? If a trade is working out in your favor and your game plan from the weekend is formulating exactly how you were looking for, I don't really set profit targets. So I would not suggest anyone else set targets, because I think that causes people to over trade a lot. So I would not suggest setting targets. But once the trade is in your favor, your strike is in the money, those 2 things should give you the confidence booster to sit back, watch the trade formulate, and just watch that setup keep going in your direction. All you have to do is increase your stop. So if you get into 5 contracts and you have 1 contract left, let's assume the contract entry price here was $1. Right? You scaled out at $1.50, you scaled out at $2.50, you scaled out at $3, right? And then last scale out was at $4. Now you have 1 contract left. That $1 contract is now, let's say, valued at $7 or $8. That is roughly $600 to $800 100% return, right? Where you would normally make on a $100 position, let's say 20 bucks or 30 bucks, here that $100 contract is now valued at $800, right? 600 to 700% roughly. That is a crazy return. Now, the point isn't to hold your full position. The point is once the stock starts to formulate into your, in this case, the gap, you should become more comfortable. And now, to hold these runners long, it's all about finding the right setups. It's about doing your homework over the weekend. Now, this HIMS trade, I think it pretty much filled majority of the gap that day, and I actually honestly didn't hold it all the way. I'll do a different video on the trade recap. As you guys can see here, this thing does not stop. We have very consistent volume. Only areas that the volume actually slowed down on was during these small pullbacks, and then every time it pushes up, volume was increasing. So finding these setups might be tough for you guys, so I'm hoping that this video kind of changes that perspective and you can do your homework over the weekend, and this will help you find better setups. What are some of the things that you guys do over the weekend that might be slightly different from my way of watching the market? And how do you guys approach your market, pre-market? Like when you're opening up the setups, what are some of the things that you do? Also make a separate video on the pre-market prep only, because there's a little bit more things that I do, such as the strike selection and setting up my active trader. That's one thing a lot of people have been asking, which I'll probably do next week or the week after on a trade review. I'll see you guys in the next video.